Hi all. Thank you so much for joining. Hi, and good evening, everyone. Thank you so much for joining us tonight on the webinar on tax planning for 2026 and tax-free retirement. So today's session is designed to help you better understand several key areas of tax planning for the upcoming year. We will be discussing topics such as tax withholding and the W4 forms, choosing the right filing tax status, tax consideration for dependents, standard deduction and compliance requirement for FBAR and FATCA, along with the strategies for tax efficient and tax-free retirement planning. Now, it's my pleasure to introduce our speakers for today's session. First, we have Biju Somarajan, founder of nrfinCorp Financial Services, who has been in this business since 2023 and has already helped more than 200 clients with financial planning solutions, including annuities, life insurance, and estate planning such as will and trust. Welcome, Biju. Joining
Hey,
him is Abdullah Zubair, founder of IRS Tax and Financials, who has been working in tax and financial services field over 10 years, helping overall 500 plus individual and business clients navigate tax planning and financial strategies. Welcome, Abdullah. And a quick note before we dive in, attendees will be on listen only mode throughout the session. Please drop any questions in the Q&A and we will address them at the end. Also, we will be conducting similar webinars in the upcoming months and will keep you posted. So, without further delay, let's begin today's session and make the most of this opportunity to learn, plan, and prepare for the 2026 tax season. Welcome all once again.
thank you, Mo. So maybe you can. Good afternoon, good evening, everyone. And this is our first webinar session that we planned as part of our initiative. And we thought of starting with tax planning and tax-free retirement. I will be covering the tax-free retirement and then followed by Abdullah, who will be covering the tax planning for 2026. Okay. So from the disclaimer perspective, and this is purely for the educational purpose, and any financial advice or anything that I believe you should directly work with a licensed professional like us, and then we will have a customized solution for each uh, client. Because it is purely based on their needs. It is not that a common solution will work for everyone. So we will. That is what the disclaimer all about. And then uh, let us go in. As Uma was saying that, because this is my agency where we started, and we have a team of 70 plus, and we are working towards multiple solutions for helping people. And as Uma was saying earlier, yeah, this is something we covered almost 200 plus families, and we did coverage almost 95 million across multiple states across US, and then we are growing as a team, and our commitment is protecting families. And coming back to the topic for the day, okay, it's a tax-free retirement. It is strategy to build uh, uh, tax advantage income for your future. So as everyone says that uh, uh, the our actual potential year of the what do you call the tax the retirement is 30 years. So and we have to face a lot of liabilities during the retirement, so we need to plan well ahead. And there is like 50% of chance one spouse in a couple live more than like up to 92 based on the current numbers now, based on the current health situation. So we need to plan for everything. So whatever we are covering here, it is just to make sure that we have options where you are being educated so that you can take the wise decision on that. Okay, so and before we start, I just need to keep an information regarding the national debt. So there are two clocks that we use to see it. One is the uh, US debt, and another one that is something like truth accounting. So why I shown you both is both of them shows the same numbers, but there are two. One is officially from the US government. That is something like total debt as of today, as of yesterday kind of thing. And it is keep on growing like a 36 to 38 trillion. And, and each taxpayer has a share of almost 97, 329 to 974 in that bucket. And per citizen, it's like 100K. That is what the numbers looks like. And why the major uh, debt service alone because this is something what you're seeing is in the future generation because we are handling a major debt. So if you look at how to handle this one, because the next slide will talk about a little bit deep on this one, but I just want to show you this number, and there are two factors here. One is the mainly the 38 trillion debt that whatever we are saying as treasury bonds and bills already issued, because they used to say that okay, already whatever we issued and the debt, intergovernmental debt like social security trust fund IOUs, that is what the official debt that will talks about. But when the actual truth value, but whatever we are saying is because unfunded money, something like a social security, because we are funding money on that. And then other thing is unfunded Medicare obligation. These are the major largest single component that we will be seeing it. So that including both, it is showing around 158 trillion kind of the number. So end of the day, what we are saying is we have a big debt. How to cover, how the government has to do to mitigate it is end of the day, it is if you see this, the next slide that talks about the taxes. So one factor is that tax has to be increased or in the future to cover this debt. So if you look at the history of the taxes, okay, from 1920 to 2025, there are multiple areas where we see that the taxes has gone up drastically up, and now we are at 37% as of 2025, but that is below the long-term average of 57.8. But historically, if you are speaking, we are at the low tax environment at this point of time. But if you look at the previous slide, the debt. So to cover that, the government has to increase the tax, okay, or increase the revenue. So these are the two options that have left out. So in this situation, we are not in a position to, you can decide whether the tax will go up or tax will come down. So it is something, it is your call right now based on the facts and figures, so that we need to, what we are doing here, it is to give a picture of what are the options you have it for the tax-free retirement. So when you retire, all of your income is going to be in one of the two pots of money. Okay, one is in the taxable bucket, another one is in the tax-free. And if you have to choose with from anyone, right? If you are in the call, which one you will be choosing? Most of the money, uh, two pots. You had most money in which would you will pick? If I put a question like that, obviously we don't want to pay taxes for our money. So obviously we'll think that, okay, we need to have most of the money should be on the tax-free bucket. So what are the options we have it? Okay. So coming back to the tax-free uh, what are the taxable buckets that we have it? Currently, for the capital gains, if you know what is capital gains and ordinary tax, so capital gains is whatever we are investing in the stocks or mutual funds or a sale of a business interest or a real estate. What we do is we will invest money, and for the gain, we need to pay the taxes to the Uncle Sam. Fine. So that will be a smaller bucket. But when it comes to the ordinary income tax, that is something that you are going to pay in the future that you don't know how much you're going to pay it. So specifically the money, whatever we are talking in terms of the retirement, it is 401k or a 401(k), simple SF, IRA, all these are our, what you call our retirement income money that we are expecting that, okay, I have to, right now what we are doing is purely we are deferring the money, whatever we are putting on 401k. We are not paying the taxes right now. We are claiming taxes, but in the future, we need to pay the taxes for the money that you put in plus the gain. So in this case, you have to pay the taxes based on the future. Okay. So in this question, I have to ask you is, do you think that taxes are higher or lower in the future? So that is something we most of the people will say that it will be more based on my experience with the people, but Uh, there are some situations maybe it can come down, but we need to prepare for all the scenarios for our retirement. So that is something I'll be covering in the next couple of slides. Okay. So so traditional saving strategies may not be enough. Like whatever we are doing right now may not be enough because we have about 6 major threats to the financial security. Okay, one is taxes. So up to 30 years of tax liability for Social Security, IRA, and 401k. Because as I said earlier, because our retirement life will be around 25 to 30 years. So you are going to pay the taxes based on the ordinary tax at that particular point of time. The another thing is market risk. Okay, so you can see the market based on the political scenarios or outbreaks and all that. We can see the market is fluctuating, and that is one way. Uh, can you take your Uma, please? So market risk is another thing that we need to be. Sorry. Yeah. So sorry. I said went for mute. So the second one was the third one, whatever I'm talking about, the inflation. That is a rising cost that purchasing power throughout the retirement. So that is one of the other threat that you can see in your retirement life. The next part is your longevity, because as initially I said, like 50 chance are one partner in a couple reach about 92, because that is another area where we need to plan it, because you have a family where one one person is living long. You have to plan it well ahead to make sure that you can cover that person also. Another thing is premature death can leave survivor without any planned income. Fine. And another threat that you can see is liquidity. So we can't liquidate the money when we need it. So that is something, because funds locked to the traditional accounts may limit access when needed. So these are the 6 major threats during the retirement. So we need to be prepared for it. So what the intention of this particular meeting is, as I said, we need to think about the tax diversification so that you have access to the money at different levels. Uh, the spread your assets across 3 tax buckets to maximize the flexibility and minimize your tax burden in the retirement. That is what we are talking about. So the first bucket, tax now, whatever we are doing, right? Whatever the money that you are going to put on your savings, checking, stock bonds, and certificate CDs and all that, we are paying the taxes and we are investing on that. Fine. The tax later is something that most of what we do is traditional IRAs, 401(k), SEP IRAs, and qualified annuities. These are the other where we are deferring the taxes for the later, where we may need to pay more taxes or less, depends upon the situation at that we are. But as I said earlier, based on the debt that the currently that we are sitting, obviously to mitigate it, the government has two options. One is increasing revenue, another thing is what you call increasing the taxes. So in this case, we are going to see some kind of a tax that tax burden will be there for us in the future. Okay. And another thing is the tax free. Whatever we talk about is what are the other options that we have it. And the one area that we talk about is a permanent life insurance is one area where we can park a portion of your money so that you have a tax-free advantage, because the money that you're going to get it from that is purely tax-free. That is one way. Another area that most of the guys we will do is Roth IRA. But Roth IRA, there is positive thing is if you are a high income earner, uh, you have a limit where you will not be allowed to do it. In this case, it is not good for that particular sector of people. So the the only next option that you have is primary life insurance that you can use it. Okay, but most of the people that is the area where you can think about it in the future, where you can have a tax-free retirement, tax-free money when you are during the retirement period. Another one is municipal bonds that you can put it. That is most of the guys. But here also, due to the inflation and all that coming into picture, the return to what we are going to get it is going to be minimal. And at the same time, you will be having a portion of some guarantees, but still there will be a small, it will not beat the inflation. So that we need to think about how we can mitigate it. And then 529 plans is something that we use for other area where for our kids education and all that. So that is one way that do it. Okay. And permanent life insurance is a powerful tax-free vehicle. Okay. And often it is overlooked as a retirement planning vehicle. Okay. So this particular solution, and we can say as we progress, what we can do is we can have a separate call to know more about it so that you can schedule a call with one of our team members so that we will take it from there. Okay. So next, how the life insurance build tax-free retirement. That is something that I can talk. Okay. Permanent. The permanent life insurance is different kind, has a whole life insurance or a universal variable. So multiple flavors are there where in long term it will build cash value that grows tax deferred over time. Tax deferred in the sense, yeah, all whatever the money that you're going to put it on this one is after tax money, and that will keep on moving, that will grow, and then where you can withdraw that as tax free. Okay. And you can borrow against the cash value as tax free. That is, take policy loans against the accumulated cash value. Unlike 401k or IRA withdrawals, this loan doesn't increase your taxable income. Okay. Um, Another one is like tax, the outcome, the life insurance is something like a transfer of risk that we usually use that for that. So whatever the proceeds that we are going to get it, you can transfer that uh, the proceeds to your legacy tax free. So these are the one of the key benefits of using life insurance as the one of your retirement strategy. So key benefits, as I said, it is tax deferred cash value growth, tax loan in the retirement, no RMDs, required minimum distribution. That is something you have to see. All your money, whatever you have kept it in 401k and all that, there is a requirement, required minimum distribution that on the age of 72, you are forced to take that money. Otherwise, there will be taxes as well as penalties on your 401ks. So because your money, you didn't pay the taxes till now, and you have to forcibly pay the taxes during that time. So that is something you have to see on the money that you put it on 401k, IRA, and all this kind of investment, the traditional investment vehicles. And then downside market protection. That is a major advantage of the life insurance contract, IULs or whole life insurance, where IUL specifically, where they are giving a proper market protection in the sense if the market is going negative, your principal is always protected. That means, for example, this year your principal is at 200k, and the next year, when the market is crashed, your 200k is always protected. It will not go as per the what you call the market fluctuations. And another thing that you have to plan around is the long-term care living benefits riders. So that is also another thing that we can attach to all these instruments and under the life insurance products, so that we can use this as our uh, one of the option when a person end up in that situations. And legacy tax-free death benefit. That means whatever we are planning to give to our kids or our heirs, all this will be a tax-free money that we can transfer. We don't want to pay the taxes. And it has a more flexibility. That means a 401k and IRA, there is limits from the IRS. So we have to be on that limit when we are investing money on that. But in case of a life insurance contract, there is no limit. So you can park your money for your future inside this one, life insurance contracts, without any major what do you call impacts, or there is no limits for it. So next question for you is the strategy right for you? Because, and this strategy is good for everyone, but anyone that is high income earners, mm, Uma, can you take care of them? Okay. So high income earners seeking to maximum tax-free income. So basically, when you are a high income earner, so this will be a good strategy for you to invest more for your future, so that you can have a tax-free income when you during your retirement life. And if people already maxed out 401k and IRA contributions, and this is another option that you can think about it. Those is the other option that we can talk about, those seeking stable long-term tax advantage growth. That's another option. So these are all the questions that we can um, uh, check to make sure that is this a right fit for you. And anyone concerned about the future tax rate increases, definitely there is an option to increase it because of the debt that each one we are sitting on the top of it. So obviously there will be a set of things that can impact us. And pre-retiring, looking to diversify their tax exposure. So these are the questions that you can ask yourself to see whether this particular strategy can help you. So if you look at the right side of it, life insurance versus traditional plans, and in the life insurance or permanent insurance kind of scenario, there is no contribution limits. Okay, so that means you can park your money there, and RMD required. There is no requirement for RMD for the permanent life insurances. Tax on withdrawals. Yes, 401k and all that, you have to pay the taxes. So if I put an analogy like, okay, uh, see, for example, because we don't know what is the taxes that you're going to pay in the future. Okay, so if somebody is ready to give you like a $3 million for your purchase of a home and saying that, okay, there is no, the rules and regulations are there. I will define when after 30 years when the loan is done. So you will not take the loan from that. Same situation we are playing here. That means that we don't know what are the taxes that you're going to pay at the last. So we need to, we are investing our money on that in a deferred way and then expecting to pay the taxes when we are withdrawing it. And in the permanent insurance, we can use an option called tax-free loans to take out the money tax-free. And market protection, there is no market protection in the 401k because if the market is going south, our money also will go in that way. But as I said earlier, there is a zero floor protection where if the market is going down, your principal is always protected. And 401k and all that, there is no death benefit. And whatever the proceeds coming from that is tax free. And the last one is LTC or living benefits that you have it. But in the case of permanent life insurance, you have all these features. So this is one of the options that you can opt it. As I said in the previous slide, this is one of the strategy that you can adopt when you want to, if you're looking for your what do you call tax-free income during your retirement. Okay, so the next step towards is the tax-free retirement. Okay, so you can approach us after this meeting so that we can have a scheduled call where we can customize a solution for you.
I'm ready. Hi, everybody. I'm Abdullah Zubair. I am doing taxes in Colorado from 2018. I used to work in IT, but now I'm fully doing taxes payrolls in Colorado from 2018. And I started learning it in 2010 from my cousin who got a big franchise in Virginia, DC, Maryland area. So right now, tax, it's a complicated issue and complicated things. There are a lot of things involved when it comes to tax liability. And whatever I will explain today, this is from my real lifetime experience, what the input I got from my clients. I've been serving almost like 300 clients, individual, 200 business clients all over in Colorado. And, clients with individual clients with high net worth around like 14, 15 million we are serving. And also business clients we have whose net worth is almost like more than 20 million, and they are with us for a while. They're happy with their service. I do payrolls and other stuff. And now I will start talking about withholding taxes, because most of the time when people explain about taxes, they miss some important key features like withholding tax, because withholding tax is one of the tax what we pay from our W-2. And once we get a job, our employer, they made us sign the W-4 certification, W-4 withholding tax certification. So withholding tax is the amount of the income tax that an employer deducts from our salary, our paycheck, before we get our net salary. And they pay directly to government on behalf of us. It's like as a pay as you go system, because it ensures that government receive tax revenue throughout the year, then in one lump sum at the end of the year. And also this W4, how you fill up your W4, that decides your tax liability, you know, because if you know about W4, then you'll be able to decide like end of the year, either you're gonna pay or you'll get a refund. Okay, so and this withholding, a lot of time we make mistakes filing the withholding, and then company, our employer deduct lesser taxes. So W4 is one of the key features when it comes to tax. And like in W4 form, you will decide either you are single or married, then if you have dependents or not, and then it asks about if you have more jobs or not. So the best way to fill up a W4 is like if you are making more than 100,000 or below 100,000, and if your spouse is not working, in that case, you can put as married and you can claim your dependents. End of the year, definitely you'll get a refund. But if your income crosses 120 and if it becomes more than 150, in that case, you should be single on W4. On W4, single doesn't decide your marital status. Still, you can file as a joint filer or married filer. So becoming single means like it will employer will deduct more taxes. When you, my suggestion is like if you're married and you're making more than 150, don't claim your kids on W4. Say no dependent, also be single, and then don't mention about any other jobs or your spouse is working, because if you mention like I'm working, I have another job, or my spouse is working, then employer thinks like okay, the other employer will deduct more taxes. And end of the year, because this is from real time experience, end of the year I saw a lot of W2s like they deducted lesser taxes. And another issue I figure out, like when both of the parents are working, they are claiming kids on both on their W4. But end of the year, when IRS see like if you have one kid and you're claiming one kid on your W4, and same time your spouse is claiming same kid on her job, it becomes two kid. But end of the year, when IRS is like only one social has been put as dependent, then they knows like already you claim deduction for two kids. And in that case, what happens most of the time, taxpayer end up paying taxes instead of getting a refund. So make sure, guys, when you guys are filing your W4 with the employer, if you are claiming kids, tell your spouse if she is working, don't claim the kids. Okay, because it becomes multiple kids then for IRS. And you will have idea that, oh, I will get a refund, but in that case, already that $2,200 as per 2026, for one kid, you'll get 2,200 if it's a SSN. On I-10, you'll get only $500. So if you claim two kids, that means you claim more. And in that case, what happens, like end of the year, either your refund will be lesser or you'll end up paying a chunk of money as your tax liability. So when you're filing your W4, make sure if your income is high, don't claim any kids, be single on there. That will save a lot of money end of the year. You don't need to pay IRS. Maybe you will get a little amount of refund. Now, my next slide will be filing status. We have 5 type of filing status: single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. So qualifying surviving spouse is like if your spouse deceased in last 2 years, then you will be eligible as a qualifying surviving spouse. And this status, not just a status, filing status, this decide how much standard deduction you will get while you're filing. As a single, like your deduction will be 15,750. Single or married filing separate. As a head of household, it will be $23,625, and married filing jointly or qualifying surviving spouse, The standard deduction is 31,500. Now here, a couple of things I want to say. A lot of clients I've seen, uh, taxpayer and spouse living in the same house, but they want to file separate, which is wrong. Because if you want to file separate, you have to stay away from your spouse at least 6 months. It can be in same state, in a different address, or it can be a different state. And a lot of time they think like, oh, I can file. Yeah, definitely you can file. You can do it like staying in same house and filing separate. But if once the audit happens, you will be in trouble. That's the only problem. And then we have head of household. What is head of household? Head of household is like, I can single parent, you know, it can be separated or divorced. If you are having a kid and you are paying for that kid, then you can claim yourself as head of household. Head of household just benefit is like in terms of tax benefit is there, nothing else. You know, you'll get more standard deduction when you become head of household. And head of household, as a head of household, you can, I mean, you might think like, okay, my kid is 20 years old or 22 years old. No, still you can be head of household claiming that kid, unless you are paying for that kid at least 50%, like if he is living, if that child is living with you, then you can claim that. And if you're paying like education or other expenses for the child, definitely you'll be claimed as head of household. My next section will be dependents. So what is dependent? Like usually we think like our kids are dependent. But beside that, your parents can be your dependent, elderly parents who is not filing taxes on their own, you can claim them as your dependent. Also, your 24-year-old child can be your dependent as well if he is living with you. And another real-time thing I have faced so many times, like it came from mostly South Asian people. Like, hey, I'm working, my spouse is not working, I'm paying for my spouse, so my spouse is my dependent. I face this question a lot. Actually, a spouse is never dependent. And this is, I don't know, like from where people get this kind of thinking, like a spouse is dependent. I mean, as a South Asian, we can think, but actually when it comes to tax, a spouse are never dependent. And as well, I said, like your 24-year-old child can be your dependent as well. And he will be treated as other dependent. And for your 24-year-old kid, you will get $500. Earlier, till 2025, this other dependent credit, that $500 was refundable credit. But one big beautiful bill, our President Trump, he made it non-refundable credit. So non-refundable credit means like if you make $2,500 in whole year, you can claim your dependents. So if you have a kid with SSN, you will get 2,200 for that kid. And if you have a kid with ITIN or your parents with ITIN, earlier you were supposed to get for per item $500. But now what the new law is like, even if you make $2,200 and if $2,500, and if you have a kid with SSN, you can claim that $2,200 child tax credit. But the credit on the item, that $500, since you don't owe any taxes, you won't be able to get that credit anymore. It doesn't have any cash value. If you owe taxes, only then this credit will be applied, and this credit will not carry forward to next year. So this year, like if you owe taxes, or the thing is like you doesn't owe any tax. Okay, suppose like on 100,000 you paid 15,000 taxes, then they will apply that $500 credit to reduce your tax liability. You will get it as a refund, but it doesn't have any cash value when you make lesser money. So now a lot of people, I mean, this year a lot of people ask me like, hey, I have two items, I'll get $1,000. I'm like, if you pay taxes, then they will only return that $1,000. But if your income is lesser, it's like 2,500 or like 3,000, you won't be able to claim that credit. Uh, Next, I'll talk about the what's the new changes on big beautiful bill which will impact us like IT professionals or like who does the small jobs, Uber, Lyft. So earlier, first was like salt tax. Salt tax is a state tax what you paid on your W-2. Earlier, salt tax deduction was 10,000. So many times what happened, if you itemize, then only you'll be able to claim that salt tax deduction up to 40,000. Otherwise, if you don't itemize, this salt tax won't be applicable for you. Second, mortgage interest deduction. Okay, this is same as well. Like if you are itemizing, only then you'll be able to get that deduction. Because itemization means like you get a standard deduction 31,500 as a merit filer, but itemized means like you can get more deduction based on your salt tax, mortgage, like charity, whatever you did. So they club it, and if it becomes more than 31,500, they will apply that deduction instead of 31,500, and that's called itemized. Like you itemized your expenses because you might have like donation, you might have property tax, personal property tax, then your estate tax, then your you know mortgage interest. And mortgage interest, here is another thing I want to explain. Mortgage interest is deductible up to 750K. That means if your house is more than 750K, they will only calculate how much interest it comes up to 750K, and that is only deductible. After that, it's not deductible. You can't claim it as per IRS rules. So mortgage interest also you can put it there in your tax file if you itemize. And interest, as I said, interest deductible up to 750K. And from next year, earlier PMI, which is mortgage insurance premium, was not a deductible. Till 2025, it wasn't a deductible item. Now they made it deductible. That means like from 2026, when you file in 2027, your PMI will be added as well. Then we have charity. You can put like at least $1,000 without receipt. Charity you can claim, and if you and charity there is no limit. You can when you do charity donations, it can be 10,000, 12,000. I have a lot of clients who does charity that much. But the thing is like if you itemize, then only charity will be deductible. If you don't itemize, still you can claim that charity. Only a state will give you some lump sum refund. Not, I mean, not like a federal. If you itemize, you will get more. Like if you do $3,000, that 3,000 will be deducted from your gross when you itemize. So $3,000 means like if I say your tax rate is 10%, that is $300. But if you don't itemize and you still put the $3,000, a state might will give you maybe 60, 70, or $100 as a refund on the charity. Then we have tips and OT deduction. So tips is like usually people who works in restaurant or Uber, they get tips. And now tips you can deduct from your gross as a single tax filer up to 12,500, and as a married, I mean there is a income threshold as well up to 150,000, and married filing for 300,000. More than 300,000, you can deduct tips deduction, and that will be like max 25,000 you can deduct, you and your spouse together. Then comes overtime credit. Yeah, this year they introduced overtime credit, and overtime credit is applicable for both a standard deduction and itemized deduction. And same, yeah, overtime credit is like as a single filer 12,500, and as a married it will be max like 25,000 you can claim. Same as tips deduction. And overtime credit, the best thing about overtime credit is like overtime credit, IRS doesn't have any way to figure it out how much overtime you did, because right now still overtime credit, the employer, they don't issue anything. They don't issue anything unless they can put in W-2. There is a box 7 there, they can put it. or in box 14 they have to use your overtime credit, how much overtime you did. So you can take the benefit of the overtime credit as well. And then in one big beautiful bill for seniors who are like older, I mean 65 plus years old, for them, earlier the standard deduction whatever was, I mean standard deduction as a single senior or as a married senior, you can add up to, if you're single senior citizen, then you can add with your standard deduction, you can add up to $6,000 more extra deduction. That is legally you can add, you don't need to show any receipt, nothing. And if you are married senior, you can do up to 12,000 for two-person. And the last one is like auto loan interest deduction. Earlier, we didn't have this auto loan interest unless we could only apply towards our business tax filing. Who has business and who has car, they used to get that deduction. But now, as an individual, uh, I mean, individual filer or joint filer, we can claim the auto loan interest deduction up to $10,000, you know, and but that car has to be made after 2025, you know, so it has to be 2025 model or future. But if you own a 2024 car model, you can't claim that interest deduction. Only thing you can claim personal property tax, which is, I mean, not all the state has that personal property tax. Like Virginia, they have personal property tax. So people who are living in Virginia, they can claim that personal property deduction. But as a, married, I mean, as living in Colorado, we can claim that because Colorado, we have registration fee, but we don't have personal property tax. And even though I don't remember if we have, that is really lesser. The Virginia registration cost a lot, and they put it under personal property tax. And last thing, I will talk about tax penalties. So tax penalty, like a lot of people, we have a salary like 100,000, but we pay tax, suppose 7,000, that is 7% tax. As per IRS rules, if you don't pay 10% tax on your AGI, adjusted gross income. So what is adjusted gross income? Adjusted gross income is like, suppose you made 100,000, then all your deductibles. That means you will get a standard deduction. As a merit filer, you'll get 31,500. So we will deduct that 31,500 from your 100,000. So it will become 68,500. And then suppose you have other deduction, 3,000 or 4,000, it will come down to 63,000 from 68. Yeah, 63,500. Now on 63,500, if you pay $6,000 tax, there is no penalty. But if you paid, suppose a lot of people I have seen, like they made 100,000, they paid $5,000 federal tax. I'm talking about only federal tax. This is not about estate, because estate side usually we don't have to do anything. Estate calculates. Estate's calculation is pretty much straight and simple. We don't claim any deduction in estate side unless there is some, I would say like some. Special occasions, like suppose you are beneficiary of somebody's IRA or like somebody's insurance plan, then you have to report it in state. Otherwise it's pretty much straight in state side. Federal only we can make changes, we can claim deductions. And if you don't pay at least 10% tax, then the, I mean, failure to file penalty will be 5% on your unpaid tax each month. And it's a compound interest they add. It's not a regular interest, it's a compound interest they add. And it will be kept at 25% max. And if you pay like minimum, I mean, if you pay close to, I would say like, suppose your after the standard deduction, your tax rate is 6% or 7%, and you paid that, you have little bit lump sum amount left that you can pay. If you want to pay within 60 days, then the minimum penalty will be like, I would say like way more lesser than the 5%. And this is if you don't pay taxes on your W-2 properly. Now, if you don't file one on time, what will happen? Because for business tax, March 15th is the last date, March 14th is the last date, and for individual tax, April 15th is the last date. If you take extension on your business tax, it will be September 14th, and if you take extension on individual tax, it will be October 15th, last date. So now, suppose you owe money. Okay. Suppose you owe money to IRS and you took extension. How will be your tax liability? If you owe money to IRS and you took extension waive your fail to file penalty. Okay, extension doesn't mean like you won't pay any taxes or anything. You are like exempt. No, extension gives you extension waives your fail to file penalty because when you don't file taxes on time, IRS charges you multiple penalties. That is fail to file penalty and fail to pay penalty on time. Two things is there. So when you take extension, your fail to file penalty is waived, but fail to pay penalty that on time that will be added there, and that is the rate for fail to pay penalty is 0.5% on the unpaid taxes. Okay, your tax liability is 6,000 and you paid 5,000. So 1,000 is there, your liability. And on that liability, it will be 0.5%. And each month, it will be calculated as each month, like from April to October, the interest will be calculated. And max interest will be like 25%. And if you go for an installment or payment plan, then the rate reduces to 0.25%. Then because then you will talk with IRS and IRS will know like, okay, this guy failed to pay and he has some issues. So they will reduce the interest rate 0.25% monthly when you will pay. And sometimes we get letter from IRS for our unpaid taxes, mostly in individual tax. And that rate will increase, like if they send a letter. Before that, if you're paying your good, if they send a letter, then it will be 1% per month as per IRS rules. So guys, tax is like complicated and big things. Our today's session, we will be talking, we covered multiple things, and this was my last topic for today's session. If you guys have any questions or anything, you can contact me offline, and also I will answer some question answers here.
All the participants, thank you so much for joining. And if you have any queries, you can see the information of Mr. Biju Somarajan and Abdullah Zubair on the screen. You can take a photo and then contact. And I think in the Q&A also they have mentioned how to contact them. So thank you so much for our speakers, Abdullah Zubair and Biju Somarajan, for your valuable insights and sharing your valuable insights with us. So today's discussion highlighted several important points, including the importance of like tax diversification across taxable and tax deferred and tax free accounts, understanding the withholding taxes and different filing statuses, and staying informed about the new tax changes and deductions for 2025 financial planning. So thank you each and every one of you who joined us today and participated in the discussion, and we truly appreciate your time and engagement. And have a wonderful evening, and we look forward to connecting with you all again for the future sessions.